If you've bought an insurance product with a guaranteed return, you may be in for a nasty surprise down the road. Hello, my name's Paul Carroll. I'm the CEO and founder of Efficient Wealth Management, a boutique wealth management firm based here in the Woodlands, Texas. As you already know, life insurance and annuity products sell well in no small part due to the guarantees that are often associated with those products. And though those insurance guarantees are relatively costly, they play well to the investor's desire for an asymmetric risk-reward profile. What on earth do I mean by that? Well, studies by Daniel Kahneman, the Nobel laureate, and other behavioral scientists have taught us that for every unit of loss in a market cycle, investors expect 2 or more units of gain. Of course, history has taught us that this is not possible. But through financial engineering, insurance companies have rejiggered the risk-reward profile and promised no losses and a taste of the upside. We already know these are expensive guarantees. But the question is, today, how can insurers guarantee returns greater than the underlying assets permit? And what do I mean by this? In The Economist, the most recent edition, 80% of insurer assets are invested in fixed income investments. So let's take 4% guarantees, for example, that were protected with bonds that are currently maturing and are being replaced with new bonds at much lower yields. This is not sustainable. These guarantees are not sustainable if interest rates stay where they are today. In fact, Fitch, the ratings agency, has warned that some insurers are taking on too much risk in search of this yield. Moody's, another ratings agency, has stated a fear that sustained low interest rates will, over time, drive a number of insurers into insolvency. The insurer savings business model relies on these guarantees. And it was a model, and still is, that plays to this asymmetric risk-reward desire profile of investors. This model thrives in an environment where short-term yields are greater than 2% and government bonds are paying greater than 4% with really no default risk. Today's zero interest rate policy that exists at the short end of the spectrum in 60% of the world's nations has created an existential threat to this model. In fact, the National Association of Insurance Commissioners have identified low interest rates as a major threat for life companies given their rate-sensitive products and investments. The challenge for investors everywhere is to really understand that fundamentally risk mitigation costs money. There's no free lunch here. And that asymmetric rewards are not reasonable, certainly not without expense. So what really is the best performing replacement for this type of product? Simply put, it is to asset allocate with a 5-year rolling window perspective. And why? Since 1929, a 65-35 asset allocation has never had a negative 5-year rolling return. They've met that guarantee. Ergo, at our firm, the 5-year mantra. What do we mean by the 5-year mantra? We mean that if you have financial needs, cash needs within the next 5 years to be funded from your portfolio, those assets should be isolated so that the core asset allocation can work its 5-year rolling magic. What have we got here? We've got a model that allows us to achieve the same goals with less costs and greater expected returns. We wish you the best of investing success. Thank you.